Hey everybody, Marty Mazur. Good morning, June 19th, 2018, Tuesday morning. As I come to you this morning, the Dow's down 323 points. Should be no surprise, as I stated in yesterday's blog post, to those of you who have been with me on the blog, to see such a decline in the market. Frankly, could be worse, or depending on how you want to look at it, could be better. And in both cases, I mean lower. As we suggested several times in our last year's year-end letter and multiple times since, the market isn't going to like this sort of action that we've seen lately on the trade front, and that it will punish, so to speak, that action severely. Hasn't really been severely punishing it by our definition just yet. 330 points feels like a lot. It's 1.3%. Takes the Dow back into negative territory on the year. Go back to the beginning of 17, we still have a real nice 18-month move. But it's not the past we're talking about, it's the current and the future. I noted yesterday, head of the President's Council of Economic Advisors stated yesterday that this is the time to do it because the economy is in really good shape. Our view of the world is he's right. If you had to do something like this is the time to do it. If you did something like this in 2007, early 2008, it would get the blame for the greatest recession since the Great Depression. Our view of the data is that we're not in that kind of territory where the economy has that kind of risk on the near-term horizon. However, there's a theory called reflexivity that begs the question, does the market reflect macro circumstances, or do macro circumstances reflect the action in the market? Everything that we've shown you here on the blog in terms of what we do behind the scenes suggests that the market reflects macro circumstances. The problem is the market is indeed part of the macro circumstance or the macro condition. It's an element. It's an important element. It gauges sentiment. It makes a difference in terms of wealth throughout the world and so forth. And the wealth effect would suggest that when people are feeling less wealthy, they become less active economic agents. So as Mr. Hassett, the president's chief of the Economic Council, said yesterday, the economy is in really, really good shape. Jerome Powell of the Fed said that last week. We've been saying that because that's what the data is telling us. So we're not at all near any kind of a big macro breakdown or any cracking of our macro thesis. But this is the kind of thing, as to repeat myself, as I suggested in the 2017 year-end letter, that ultimately will test that macro thesis. It'll take some time. We don't go from bull markets to bear markets overnight typically, and when we do, that tends to be a correction, not a bear market. So we'll see how far this plays out. I do see further downside to the extent that this continues, but I do see that downside waking the players up, hopefully soon enough to get things back on track. Then, given this macro backdrop, you're likely to see very big fast gains in the market as well. Of course, again, I repeat, that's contingent upon getting smarter when it comes to trade. Screen in front of you should look familiar if you've been with me on each of the videos. This is, I think, the last one I did when we were addressing the current correction that we're still in. Here's the peak on January 26th. Here's the downtrend line we established that we broke in early May. Maybe tested it the next day or two and have not tested it since. I suggested then it would be normal to come back and test that and see if we do get support there. There would be double support, but it doesn't look like we're going to have that opportunity. If it tests this, it's actually going to end up making new lows. I said then the average duration, average for your typical 10+% correction is 209 days, which would mean if this one is going to fall on the average, somewhere in late August is where we would get back to new all-time highs. So certainly on track with that timeline, and the trajectory is almost perfect with that timeline. This is this morning, of course. So aside from the protectionism that we will continue to talk about and report on here, there's also a thing called seasonality. Now, we aren't big fans of trading seasonality, and so we are very aware of it. And we do, gauge short-term expectations in some of our dialogue with clients based on seasonality. If you look at the month of June over the last 10 years, hasn't really been a good year at all, save for healthcare, utilities, and ironically telecom, which we just increased our weighting to. Everything else is noticeably negative. Tech down 2.8%. This is on average over the last 10 years. Materials 2.8%. Consumer staples even down 2%. The S&P down nearly 1% on average for the month of June. The good potential news, I guess, would be that if you just hang in there, the last 10 years, July has actually been a great month. You see tech, financials, everything bouncing back. I will submit to you, though, however, that if we're embroiled in a trade war in July, that I would expect this to look more like your June chart that I just showed you a second ago. So folks, again, the general backdrop, the macro backdrop, if you will, is bullish. It's positive. We updated our analysis yesterday. There's absolutely nothing there to panic over. We are tweaking some of our sector weightings just on the margin to accommodate for what we're seeing in the technicals. But by and large, this remains an environment to stay relatively growthy in, to expect and accept volatility along the way. Unfortunately, we have this curve that's kind of being thrown at the market, and that's something that continue to address and talk about here on the blog. Have a good day. Stay tuned. I'm sure there'll be much more coming from us as the week unfolds. Take care. Bye-bye.